I would be taken out of this trade at plus 300 pips, give or take. This is a 310 pips. That's a 1 to 31 risk to reward ratio. Hey guys, what's up? Brandon here. Let's go. So today we're going to be talking about the ECR. Yes, I am going to do a video on it again, but in this video I am going to break it down as simple as I can, because there are so many questions surrounding it as of recent. I mean, before there were a lot of questions, but I tried to answer them one at a time. I hope that this video will be the answer to every single question that you might have. Before I go into my charts, I want to talk to you about the ECR very quickly. So I want this to be very, very clear. This is the way I understand the market, and this is what I use, right? By no means am I saying this is right, or by no means am I saying that this is the only way to make money in the market. This is just what works for me. It makes sense to me, and thus I'm telling you about it. It's up to you whether you choose to use it or not. If you can simplify it and understand it yourself, then kudos to you, congratulations. But this is what works for me. It is a very, very simple system, right? In the sense that it doesn't have a lot of steps. Now, don't get that confused with the fact that it's easy, because it's not, all right? You're going to realize when you start to put it into practice, or if you try to put it into practice, that it takes a little getting used to, because I don't want to say it goes against what you know, but it does have a lot of, for want of a better word, it has a lot of things that you need to take into consideration. The ECR is a structure-based system, meaning it is not a moving average crossover like what, some people might think it is. I know that people are going to look at it and say, oh gosh, EMAs, yeah, that's failure. Let me tell you something. It is a structure-based system that uses moving averages as a criteria to enter the trade. I say this all the time. If you go back in any of my other videos, you would hear me say it, that direction is the answer. Your entries are literally like 5% of what is necessary to actually execute on the trade, right? That's actually where the execution comes from, in the entry. The ECR is a entry technique. It is not the above all and end all. It's not the strategy per se. So you have to obviously understand market structure. You have to understand psychology. You have to understand the emotions and who is trading, who is in power, who's not in power. There's a lot of things that you have to take into consideration before you can even think to put moving averages on your chart and then look for an ECR. So I hope that, this kind of clears things up, right? Another thing I want to make very, very, very clear is, a lot of the time people ask, hey Brandon, what moving averages do you use? Everybody asks this question, and I'm going to answer it once and for all, right? The answer is, it does not matter what moving averages you use. Let me be honest with you. The moving averages, regardless of what number you use, at some point, your candlesticks or your bars or whatever it is you're using are going to come to any particular moving average. So if you use a 10, eventually price will hit the 10. If you use a 20, eventually price will hit the 20. If you use a 30, eventually price will hit the 30. 100, price will hit the 100. 500, and so it goes. So what that means is, it really doesn't matter what you use. Rather, it is understanding how they work in tandem and in relation to the structure that you're seeing. That is why I say all the time, it is not a moving average strategy. You don't just sell a random cross or buy a random cross. That's literally, I don't want to say ignorance, but that's literally just guessing. What I am doing is I'm not guessing. I'm actually trying to have an analysis based on the structure, and then I'm looking at the chart and then putting my EMAs on to kind of give me, okay, well, maybe this is a good place to enter based on what my analysis has told me. I hope that makes sense. I'm going to go into the charts now, right? And I'm going to do something. I'm going to remove all of the moving averages so that you can see just the structure of the market. Right? And I'm going to explain the structure of the market, and then and only then I'm going to put the moving averages back on so that you can see what it is hopefully you can see what it is I see, where I'm looking for specific things in relation to what the chart is telling me. That is the ECR. The ECR is just the entry. You understand? It gives me the reason to enter. That's it. That's literally it. Yeah, so without further ado, let's hop into my chart. Let's take a look at what's going on. All right, so we are in my computer now. Let's take a look at the chart. So as I would have mentioned, I am taking all my moving averages off, all my drawings, everything, so that I can show you bear market structure, right? At least the way I understand it. Again, as I would have mentioned as well, everything about what I know could be wrong, but this is how I understand it, and it's what works for me. So without further ado, this is USD CHF on the 15-minute time frame. Now, what I want you to understand, and this is very important, before you can even put your moving averages on the chart and begin to look for any kind of ECR or any kind of moving average respect or retest or anything, you need to understand the direction of the market. This is very important. It is so important that if you don't do this, it doesn't matter what you do, it is going to operate like a random moving average crossover, because at that point, that's exactly what it is. What I do, right, and in order for the ECR to work for me, what I do is I tend to try to make sure I understand the direction of the market first, and then I would look for a moving average cross by virtue of the ECR in the direction of my bias and analysis. So how do I know, or for want of a better word, how do I understand what direction the market is typically going to go? So the ECR as a whole has a system, or as a strategy. It follows two very, very simple rules, right? Rule number one, do not go against the momentum unless a reversal is clear, right? And rule number two, if a reversal is clear, the first crossover of your moving averages, or the first ECR after your M or your W pattern, which is your reversal at that point, is the valid ECR. Yeah? So, long story short, what I want you to understand, let's break it down in a little more detail. Don't go against the momentum unless a reversal is clear. So how do we discern a reversal? A reversal can be seen in one of two ways: a head and shoulders pattern, or an M or a W pattern. It is very, very, very important, and we'll more focus on the M's or the W's because that's what I prefer to use, right? It makes more sense to me, right? But it is very, very important that you understand that you cannot see an M pattern any and everywhere, or a W pattern any and everywhere. An M pattern is only going to be available at the end of a bull trend. Why? Because an M pattern is a bearish reversal pattern. It is designed to reverse in the bearish direction. And a W pattern is only going to be seen at the end of a bear trend, because a W pattern is a bullish reversal trend. It is designed to reverse in the bullish direction, right? So what that means is you cannot see an M every and anywhere. This is not an M. This is not an M. This is not an M. Why? Because these are bear trends, right? They're happening in a bear trend, right? Even here, this is not an M, right? This is not an M. This is not an M. Why are these not M's? Because they're not at the edge of the bull trend. Now, that being said, and this is very simple to understand, all you need to do is look for your trend, and at the edge of that trend, meaning the end of that trend, you're going to look for your M pattern. So let me show you what I mean. The first thing to do, obviously, this should be easy to understand. You're drawing your trend, right? We're not drawing the trend so that we can just randomly buy into the trend line. No, because we are looking to see, right? And listen to it. We are looking to see if there's a trend in the first place so that we can find a reversal against that trend, right? It's very simple. So how do we know that this here is not an M pattern? Because according to what I just said, if there's an M at the edge of the trend, then it's viable, right? No. Remember, how many taps do we need to make a trend valid? The answer is simple, 3. How many taps do we have here? 1, 2, 3. You would realize that your M pattern happened before the third tap happened. Does that make sense? Therefore, this is not a reversal, or this M cannot be a reversal, because remember, you're only going to find an M pattern after a valid trend line. I hope that makes sense. You're only going to find an M pattern after a valid trend. So anything after this third tap, if you find an M there, then you could say it's viable. Then you could say it's valid. But anything before this third tap, you have to look for continuations, right? So, and I'll explain that later down in this video as well. So that being said, you have tap 1, tap 2, tap 3, right? And then the market continues up, it creates a high. This is your first high. It then falls away, but instead of falling all the way back down here, what does it do? It decides to go back up again and create a tap off of that previous high. So you have 1 tap, 2 taps. Your M pattern is to look exactly like this. 1 high, come back down, go right back up to the second high, maybe just a little bit higher sometimes, and then drop again. In other words, you are going to look for M patterns that look exactly like the letter M. This is not an M. You wouldn't draw an M like that in the real world. And this is not an M, because you wouldn't draw an M like that either. You would typically draw your M's like this, and vice versa for your W pattern. Yes? That makes sense, I hope. So, long story short, this is the makings of my M pattern. What this tells me is the dealer, which is the person who's in charge of the market, who really controls and moves the market, use the liquidity in his favor and all of that. What it tells me is he wants to basically reverse the market against all of these buyers here. So that being said, I have already, for want of a better word, discerned the direction. Right? Now, obviously, it is a speculation. As with any analysis, it's a speculation. It's a prediction. I am not pleased with that, because I could say, well, maybe I think it's an M up here and then just randomly sell it. But what are my entry criteria? The fact that it's just bouncing off of the high, I don't trust that. That's not enough. So what I did is I wanted an additional confluence to enter my trade. Right? I wanted something else. I wanted something to help me, to assist me, give me training wheels. You understand? Handicaps, right? The more things I have to give me, for want of a better word, to give me a better entry, or to give me a safer entry, or to give me a higher probability of winning, the better it is for me. So what I did is that's where I started to play with the moving averages and try to get them to work in tandem with, you know, this structure that we're looking at. And that's when I realized this is what's going to happen. So what happens is, if the market does indeed drop, and as you can see, that's exactly what happens. When the market drops, right, this is now known as your reversal, because you have your 3 taps, 1, 2, 3, you have your 3 taps, and then obviously the market just begins to reverse. Now, if you sold it here, congratulations, but yes, you'll be up, but again, you're really only selling because of one criteria, right? What I did is I took it a step further by putting 2 very fast period moving averages on my chart, very, very fast periods, right? So they react to price very, very quickly, and thus they gave me a very good opportunity to sell. So at this point, I'm not just going to sell it again, because obviously it's very bearish. If I were to sell it here, obviously the likelihood of the market retracing on me is very high. This is why it is called an ECR. ECR stands for exponential moving average, crossover, and retest system. So you have your exponential moving averages here. You have your crossover. So now we need the retest. Say ECR. We're looking for the R now. So at that point, I'm going to look for a retest. A retest, it typically you want it to touch the moving average in question, but you can get away with it if it doesn't. It is all down to your discretion and based on surrounding market structure. And I'll tell you what I mean by that right now. You can see that there's a moving average right here coming, but you can also see that there's a little zone right here. So what I would typically look for in this scenario is for the candlestick to push back up, retest both the moving average and this zone. So let's see what happens. That's my entry. That is literally my entry. You can see it's a perfect retest of this zone. It's a perfect retest of this cross. And at this point, this is where I would sell it with a 10 pip stop loss. And that's my stop loss right there. My first target is actually right here. This is literally my first target, because this is the last area where traders would have been buying. We know that the dealer wants to reverse the market against all of the buyers. So at this point, I'm not going to put a take profit there, but this is where I am anticipating the market to go, just a little lower than the zone. Let's see what happens. So you can see it gives me a little bit of drawdown. Maybe what? It gives me about I would say it gives me about what? Less than about 5 pips of drawdown. All right, cool, not bad. And let's see what happens. Goes into the new day and it plays here for quite some time. It comes back to my entry. At this point, I am not trailing my stop, nor am I putting my stop to break even because the market hasn't decided on a direction as of yet. And look at that. That is absolutely beautiful. That's absolutely beautiful. So this is my first target here, right? Meaning this is where I am anticipating for the market to go first and foremost. The next place I am anticipating the market to go would be right here because this is where the next set of buyers are. And the last place would be right here, which is where I am anticipating the market to go last. So let's see what happens. Isn't that beautiful? That is absolutely insane. So with this one trade, with a simple analysis, one entry, one analysis, I had a 10 pip stop loss and the ability to make 112 pips in the space of about a day, right? If you watch, right, I'm still anticipating the sell straight to the lower zone. Look at that. The market goes all of 150 pips in my favor. And this is with a simple pair like USD CHF. This is not gold or anything like that. This is an absolutely perfect ECR. Does that make sense to you? I hope it does. This is what I see on a day-to-day basis, right? Now, this is the ECR in relation to a reversal. Now, we know that the market can either go in a continuation setting, in an accumulation setting, or in a reversal setting. The other direction obviously would be, or the other way to use an ECR would be to use a continuation. So I'm going to show you that now, right? So what I'm going to show you is, I'm going to remove my moving averages again, right? And show you an example on the gold, right? People oftentimes do ever believe that you could trade gold with a 10 pip stop loss, but I can assure you, you absolutely can, right? So let's use the replay function. All right, and we'll put it right here. Nice. So on gold, what is the rule, right? The rule is don't go against the momentum unless a reversal is clear. In this case, we have a trend, right? So you can see that this is your trend. You can see that this is one of them. And you can also say that this is also one of them here, right? We can see that this is also one of these trends here. Cool, no problem. So that being said, right, I am watching to see, right? I am watching to try and pay attention to the fact because you have 1 tap, 2 taps, 3 taps, right? I'm watching to see, did gold reverse off of this high? No, because remember, we're looking to find a reversal. If we're looking for an M pattern, we're looking to see 2 very distinct highs or a head and shoulders pattern. And neither of those are prevalent at this high, which means I cannot anticipate gold to be in, or to have the opportunity for sells. I hope that makes sense. That being said, I am not going to look for a reversal at this point, or rather, I'm going to look for a continuation. Now, you can tell that gold is bouncing off of this trend line here. Does that mean that you're just going to randomly place a buy because it bounced off of the trend line? No. Put your moving averages on and you're going to look for an ECR that aligns with your bias. So let's see. Right? So obviously, because we're looking for continuations, because we are not anticipating sells, we're going to be looking for buys. So that means we need to look for a buy bias, meaning a buy or a bullish ECR in alignment or in relation or in synchronicity with my analysis. So let's see what happens. Right? And it starts to move up. There we go. You have your moving average cross. Now we need the retest. Remember I said you can get away with your retest not necessarily coming back to the EMA. Let's see what happens next. That's my entry. That's literally my entry. You know why? Because even though it didn't come back here, even though it did not come all the way back here, it did retest the zone. So let's see. So this is my zone here, right? That's my zone there. My entry is literally here with a 10 pip stop loss. Now you could go on a lower time frame, but that's my entry right here, 10 pip stop loss. Let's see what happens. Next candle gives me some drawdown, no problem. Boom. And after that, all I am doing at this point, literally all I am doing at this point is letting the market do what it has to do. As you can tell, gold would have moved over 140 pips in my favor. in less than a day. My minimum target is up here. This is literally my minimum target because this is the last area traders would have been selling, which means I know the dealer most likely wants to go back to this area to capture that liquidity. Let's see what happens. Boom, he breaks the area completely breaks this area. And as you can tell here, this is over 354 pips in my favor. That is a 1 to 35 risk to reward ratio. Just saying, right? And all here, I would be trailing my stop loss. My stop loss would have been safe right behind this moving average right here. And let me see how long I would have been able to stay in this position, right? So it's still, I still trailing this slower moving average here, right? Nice. Let's see. I don't know when I'll be taken out of this. Let's see. That's what I'll do. Right. That's what I'll be taken out, literally. I would be taken out of this trade at plus 300 pips, give or take. This is a 310 pips. That's a 1 to 31 risk to reward ratio. So in other words, follow the rules of the ECR, and the rules are very simple. Don't go against the momentum unless a reversal is clear, and that is exactly what happened in this case. A reversal was never clear, therefore I had no reason to look for sells. And in the case of USD CHF, a reversal was clear. So the first cross of your moving averages, any two moving averages that are very slow and very fast periods, so 5, 10, 15, 20, 50, anything less than 100 is mostly going to work, right? Any combination, so you can use, I'll give you an example. I use the 10 and the 50, but you can use the 14 and the 50, you can use the 20 and the 50, you can use the 5 and the 20. I'll give you a tip. The faster periods you use, you're going to suffer with your accuracy, but you're going to get better entries or faster entries, lower entries in cases of buys and higher entries in cases of sells. But your precision needs to be very up there, meaning you need to enter right as that last candle close, right? And that's really, that's what it is the ECR is. That's how I do it. That's how I make the decisions that I make. And that's how I am able to, take a 10 pip loss and be okay with it. I'll tell you now, today is the 21st of February. It is 10 o'clock in the morning, and I am down 10 pips for the week because I would have taken a trade just like this on US 30 last night, and I would have lost. Now, I use the 1 minute time frame to enter for my sells on US 30. I'm going to show you it very quickly here. I'm down 10 pips on US 30. And if I'm being honest with you, it doesn't really matter. It honestly does not matter to me because I know later in the week, all I need is one trade to go in my favor, and it's going to give me everything back. Literally everything back. So I'm cool. I'm Gucci. Either way, it is what it is. It's just it's the nature of the business that, you're going to lose some trades. All right. My philosophy is, if I know I'm going to lose, I should try to make sure that my losers or my losses are as minimal, as minuscule, or as mitigated as possible, so that my winners can engulf the losers. That's it. That is how I trade. That's essentially what I do in a nutshell and broken down in its purest form. One thing I want to make sure you understand, and I think I would have said it earlier in the video. If I didn't, I'm saying it now. This is nothing compared to what you need to understand in order to be successful in this space, right? This is understanding what I showed you here is probably about 5, maybe 10% of what you need to understand in order to be successful in this space. You still need to have a good handle on your emotions. You need to have a good handle on the way that you think and the way that you see. You need to have a good handle on your practice and your ability to replicate this exact setup, right? You need to have a good handle on journaling your trades so that you can know when it works for you best. I can tell you it works best in Asian, but it works every time, more or less in any time of the day, right? But it works best in Asian based on my findings. You need to have a trading plan that gives you these exact rules, and then you need to follow that trading plan. You need to also have a very, very, very good understanding of risk management, as that's what essentially, that's where the power of the system comes from. And yeah, this system itself, like I said, is about 5 or 10% of what's necessary to be even remotely successful in this space. So I hope that, this breakdown answers all of the questions. I don't think that there are any more questions, but I've been proven wrong before. If there are any questions, again, you could reach out to me at Ikata Trading. So that's it. All right, guys. So that is well, I thought it would have been a short video, but in the attempts to answer all of the questions, unfortunately it has gotten a little longer than I would like it to be. But that is a look at the ECR and what it is I do and how it is I do it. I have created this system myself. I have been trading this for years and it has given me very, very good results. You do need to put a lot of practice in, because as you would have realized, the practice doesn't come with understanding the cross, you know. The cross is easy. It's understanding what's going on in the chart itself so that you can get an idea as to what direction the market is going to go. And then, and only then, you're going to put the put the moving averages on, look for the ECR that aligns with your analysis and bias and entry. And then you take your trade. Yeah? So guys, I hope that you enjoyed this. If you did, please hit like on the video. It does help boost this and boost the video and all of that. Obviously, I want this to get out so that people can see what it is I do, and obviously this is to answer the questions surrounding what it is I do. Comment below, what do you think about my approach? Do you think it makes sense? Do you think it doesn't make sense? Do you think it's stupid? Do you think it's genius? Let me know what you think. I know a lot of people are going to have something negative to see because, again, it's different. You understand? It applies a different approach, but I digress. So other than that, be sure to hit subscribe and ring the bell, so if it is you want more videos like this from me. And yeah, if you have any questions, you can reach out to me directly at Ikata Trading on Telegram, Instagram, TikTok, and well, obviously subscribe to my YouTube. Other than that, I will see you all in the next one. Peace out, guys.